Stephen Major joins us. He's the Global Head of Fixed Income Research at HSBC. Stephen, good to see you this morning. Thank you for joining Matt, Anna and myself. So here we are. We've got the Bank of England on hold. No shock there. Stephen, given the data that we've seen, retail sales weren't that bad. You got the unemployment numbers in the mix, just a little bit of a jolt. What does all of this do to the Bank of England from your perspective, 2018? On hold in perpetuity, on hold to 2019? Where are we?
No, I heard what you just said regarding the Bank of England's comments on Brexit, and I guess if I add it all up, and that includes looking at the data and trying to make some projections for 2018, I get the sense that they're looking for air cover to increase rates for whatever reason. And in the last few months, there's been an inflation rationale, hasn't there? Because we had some upside surprise. There's been discussions about the financial stability side, so worrying about asset prices and excess leverage. And now you've got the Brexit breakthrough, if you want to call it that. All of that, I think, is pointing in the right direction to continue the modest increases in rates. So I think the idea that the interest rates go up is not going to be a surprise to anyone, and that they want to keep that expectation in the forwards. So it's a kind of tightening in itself, isn't it? Because if the Bank of England points to higher rates, one hike or two hikes coming up, if they do that, then it keeps a floor under sterling. And the interesting thing is that sterling does seem to be doing most of the work in this regard. So whilst we tend to look at the gilt market and where the gilts will be at the end of next year, I doubt they'll move that much, because really the slack is being taken up by sterling.
Stephen, would you call it a Brexit breakthrough? I mean, if Jean-Claude Juncker, Donald Tusk and Mark Carney all say Theresa May did a great job, doesn't that mean it's about Brexit light?
I'd rather not call it anything, Matt, to tell you the truth. I used the quote on the set before me, because one of you guys said Brexit breakthrough. You're right. It's
a term a lot of people use, but I mean, the default setting is staying under EU regulation, EU citizens getting Court of Justice jurisdiction, paying for everything well past 2020.
Let's be more precise and put it slightly differently. If the markets and everyone concerned is so obsessed about how bad everything's going to be, it means they're on the left-hand side of the tail risks and they're worried about doom and gloom. So anything that distracts us from things being terrible is a move towards the right-hand side, and so therefore is slightly more positive. I think that's more precise. Yeah?
Yes.
So maybe we were just too beaten up and too gloomy.
So, Stephen, if this is about giving the Bank of England air cover to increase rates, will the UK economy be strong enough? What's your assessment of how strong it will be with this, the reduced speed limits and that the Bank of England likes to talk about?
Well, that's right. You've got to take everything into context, Anna. And I mentioned just now how you've got asset prices and financial stability as a key factor as well. So what would happen if, for example, the data was OK and the Brexit negotiations were all right, but asset prices were falling sharply? Now, that's the reality that we might face. I'm not saying it will happen, but I'm saying it's a possibility that in 2018 you could see house prices going down or asset prices, equities falling or whatever. And that changes everything, doesn't it? So that's why all of these central banks, including the Bank of England, are having to look at much more than the cyclical data patterns and the inflation rate, if you like. It's much more complicated now because we've all recognised that asset prices have got rather inflated.